Your brainstem physically severs conscious control over your heart rate to prevent fatal hesitation, a biological override mirroring exactly how a manager-managed LLC severs beneficiary control to silently divert an inheritance. This is the story of the Vance family, names changed for privacy, and how a single unrecorded operating agreement quietly redirected a multi-million-dollar estate. My father, Arthur Vance, spent 40 years acquiring commercial real estate in the Pacific Northwest. He was a methodical man. He believed in concrete, in steel, and in the immutable nature of properly filed paperwork. When he passed away on October 12, 2021, at the age of 78, my two brothers and I expected a straightforward probate process. The will, drafted and notarized in 2015, was explicit. His estate was to be liquidated or divided equally among the three of us. But a will only governs what is actually inside the estate. And as we would soon discover, the crown jewel of his portfolio had been quietly removed from the board long before his heart stopped beating. The setup for this divergence began in early 2021. My father's cognitive health was declining, a slow erosion brought on by vascular dementia. My oldest brother, Marcus, who had always been involved in the day-to-day management of the properties, stepped in to assist. In March of 2021, Marcus was granted a limited financial power of attorney. The stated purpose was to handle tenant disputes and manage routine maintenance on the properties. It was a practical decision. Or so we thought. By August of that year, my father was moved into full-time memory care. He was no longer signing checks or reviewing leases. The administrative burden fell entirely on Marcus. We checked in weekly. We reviewed the high-level financial summaries Marcus provided. Everything appeared normal. The rental income was stable. The property taxes were paid. The primary asset in question was a mixed-use commercial plaza in downtown Portland, valued at approximately $4.2 million. It was the anchor of our father's portfolio, generating nearly $30,000 a month in net operating income. According to the 2015 will, this plaza was to be held in trust or sold, with the proceeds split three ways. On November 3, 2021, our probate attorney filed the initial inventory of the estate with the county court. I sat in the attorney's office, reviewing the spreadsheet. I scanned down the list of assets. The residential properties were there. The liquid brokerage accounts were there. But the Portland Plaza was missing. I asked the attorney about the omission. He assumed it was an oversight and requested the deed from the county recorder's office. 3 days later, on November 8, the title report arrived. The Portland Plaza was not owned by Arthur Vance. It was not in his estate. According to the county land registry, the property was owned by an entity called Vance Horizon Holdings LLC. The quitclaim deed transferring the property into the LLC was dated August 4, 2021. It bore my father's signature, witnessed by a notary public in a memory care facility. I immediately requested the corporate formation documents from the Secretary of State. The articles of organization were filed on July 28, 2021, just 1 week before the deed transfer. The registered agent was Marcus. The stated purpose of the LLC was general real estate investment. But the articles of organization only tell you that an LLC exists. They do not tell you who holds the power. In family business law, there is a critical distinction that dictates the flow of authority and capital. It is the difference between a member-managed LLC and a manager-managed LLC. In a member-managed structure, all owners have an equal voice in daily operations and distributions, proportional to their ownership. But in a manager-managed structure, the members are essentially passive investors. The manager holds unilateral authority over the company's assets, bank accounts, and distributions. Looking at the initial filings, I noted 3 distinct structural anomalies. First, the unilateral amendment clause allowing the manager to alter the operating agreement without member consent. Second, the guaranteed payment provision for management services. And third, the complete lack of a mandatory distribution schedule. Which of these three red flags would you have flagged first as the primary mechanism for diversion? Let me know in the comments, 1, 2, or 3. For me, the true mechanism of diversion wasn't fully visible until we obtained the internal operating agreement. Because it was an unrecorded, private contract, Marcus was not legally required to file it with the state. We had to formally demand it through our probate attorney. He delayed for 6 weeks, citing the need to consult with his own counsel. When the 42-page operating agreement finally arrived on my desk on February 2, 2022, the architecture of the diversion became clear. My father was listed as the sole initial member, holding 100% of the membership units. Marcus was listed as the sole manager. Section 4.2 of the agreement granted the manager absolute discretion over all financial distributions. Section 7.1 established a guaranteed annual payment to the manager for services rendered, capped at 20% of the gross revenue. But the most devastating clause was Section 9.4, the succession provision. It stated that upon the death or incapacitation of the sole member, the manager was authorized to admit new members or liquidate the assets at their sole discretion, entirely bypassing the member's estate or will. My father had signed away his testamentary control. The LLC structure had effectively severed the inheritance from the probate process. The will was irrelevant because the will only governed assets owned by the individual. The plaza was owned by the LLC. And Marcus controlled the LLC. With the legal structure understood, the next step was forensic accounting. We needed to know what had happened to the cash flow since the LLC was formed. We subpoenaed the bank records for Vance Horizon Holdings LLC from KeyBank. The statements arrived on March 10, 2022. I sat with our forensic accountant, tracing the ledger line by line. From August 2021 through February 2022, the plaza had generated roughly $210,000 in net operating income. But the ending cash balance in the LLC's operating account was just $14,000. The rest had been dispersed. I looked at the wire transfer log. On September 15, a wire for $85,000 was sent to an external routing number. On November 12, another wire for $120,000. On January 8, a transfer of $240,000. In total, $850,000 had been wired out of the LLC. The memo lines on the transfers read, management fee, guaranteed payment, and capital reimbursement. The receiving account was a personal checking account held solely in Marcus's name. He hadn't just secured control of the $4 million asset. He had already begun liquidating its cash flow, classifying the withdrawals as authorized managerial compensation under Section 7.1 of the operating agreement. The confrontation occurred on April 5, 2022, during a court-ordered mediation session. The room was sterile, dominated by a long oak table. Marcus sat on one side with his corporate attorney. I sat on the other with our probate litigator. I did not raise my voice. I did not accuse him of theft. I simply slid a copy of the KeyBank wire log across the table and asked him to explain the legal basis for the capital reimbursement. His attorney spoke first, citing the manager's fiduciary right to compensation. He argued that Marcus had spent countless hours managing the property during our father's decline, and the operating agreement explicitly permitted these draws. He framed it as a standard business transaction, entirely divorced from the emotional context of a family inheritance. But in corporate law, a manager of a closely held company owes a strict fiduciary duty to the members. This includes the duty of loyalty and the duty of care. When a manager engages in self-dealing, the transaction is subject to the entire fairness standard. The burden of proof shifts to the manager to prove that the transaction was entirely fair to the company. $850,000 in management fees over 6 months, for a property that already had a third-party management company handling the daily tenant operations, is not entirely fair. It is a breach of fiduciary duty. The aftermath of that mediation was a protracted legal battle. On April 18, 2022, we filed a petition in the Chancery Court for breach of fiduciary duty, seeking the immediate removal of Marcus as manager and a temporary restraining order to freeze the LLC's bank accounts. The injunction was granted on April 22. The accounts were frozen. But the legal reality of piercing a corporate structure is that it requires time, capital, and immense psychological endurance. We were no longer just siblings navigating grief. We were opposing counsel in a corporate dispute. The settlement negotiations dragged into late autumn. Marcus's legal fees were bleeding the very assets he was trying to protect. Ultimately, in December 2022, we reached an agreement. Marcus was removed as manager. The LLC was dissolved, and the Portland Plaza was transferred back into the probate estate to be liquidated and divided according to the 2015 will. He was allowed to keep $300,000 of the $850,000 he had withdrawn, classified as a final settlement for his administrative time. The remaining $550,000 was returned to the estate. We recovered the asset, and we recovered the majority of the diverted funds. But the family dynamic was permanently fractured. Rebuilding after a financial betrayal within a family is not about restoring what was lost. It is about accepting the new architecture of your relationships. The trust that took decades to build was dismantled in a matter of months, replaced by operating agreements, injunctions, and settlement releases. Estate planning is often treated as a mere administrative hurdle, a checklist of forms to be signed and filed away. But as this case demonstrates, the specific legal structures we choose carry profound psychological and financial weight. A will expresses intent, but an LLC dictates control. When we rely on complex corporate structures to manage family assets, we introduce the cold logic of corporate law into the fragile ecosystem of family trust. We assume our loved ones will act out of familial loyalty. But the law assumes they will act according to the operating agreement. In the end, the documents govern the outcome, not the bloodline. And as I review the final dissolution papers, one unresolved question remains, one that no forensic accountant or corporate attorney can answer. Did Marcus design this manager-managed structure from the very beginning with the explicit intent to divert the inheritance? Or did the absolute, unchecked power of the operating agreement simply create a temptation he was ultimately unable to resist? The structure was built. The override was engaged. And the hesitation was entirely removed.